Hello, everyone. Welcome back to Practical Prosperity. This is a weekly show built for people coming into the real world. So, whether that's out of high school or just graduating college, this podcast is primarily made for you. Alec and Nick are laughing right now because we just had some serious technical difficulties and cold difficulties. But regardless, my name is Cole Jensen, and by my side, I've got my co host Alec Eisman and Nick Overbeek, who are also my good friends. And our goal is to give down to earth advice to young adults through conversation and stories. So, whether it's how to lease an apartment, making your first investment, or starting your own business, we've got you covered. The ultimate goal is to help people live a financially free and fulfilling life. We are available anywhere you listen to podcasts, and then we're also on YouTube in a more exciting video format, so be sure to check that out. And especially this episode, because we are going to be going over money basics, absolute core money basics, with the bread and butter being budgeting and saving, and then, of course, investing. So, what I'm going to do, and I really recommend you guys go to that YouTube video if you can, the YouTube version. But I'm going to be sharing my screen, and I'm just going to basically just be going through a PowerPoint. So, let's give this another go because this is where we ran into difficulties last time. All right, let me share the screen here. All right, and then we'll bring this up. Oh, beautiful. Oh, beautiful, beautiful. Okay. I'm kind of bummed because on the YouTube one, now you guys can't see the faces. That's why we ran into an issue last time, but we're just going to let this rip. So, you guys can see this, Alec and Nick?
Yes, sir.
All is good. All right. So, this is from my company. It is from essentially a group of engineers and some business executive type people. This was actually a PowerPoint from last year, and I just converted it into a little bit more of a modern format, but I didn't change out any content at all. So I'm not saying I own any of this. We are not ones to give financial advice, but I mean, this is just money basics. Take it with a grain of salt. But I will just say that this is from experienced engineers who have went through this whole process, that they are in the retirement phase now, also from middle-aged entrepreneurs that have family, they've got a home, they've got all this type of stuff, and then also some new ones like me where we're really starting to get that solid income and starting to live out in that real world. So a little bit of an overview. So we're going to go through literally the basics: budgeting and saving, insurance, taxes, investing, credit, loans, and then finally we're going to close off with some actions, because this is practical prosperity. So we want to give you guys something actionable and practical that you can go do right fucking now. So here we go. Look at this. The basics. Money. Yeah, this PowerPoint. If I were to do this, maybe I'd do that some other time. I could make my own format, but anyways. All right, so absolute basic of money is make more than you spend, right? If you make $1,000 a month and you spend $1,200 a month, you are obviously gonna fuck yourself. So that is like the number one rule. Another basic is putting your money to work. So meaning this is you should make your money work for you. Like it can always be doing something other than just sitting. And I'll talk a little bit about inflation later. But there is different buckets that you should put your wealth in. So some of you may have heard of this 50, 30, 20 rule, or 50, 30, 20 method, whatever you want to call it, where 50% goes towards your needs, 30% goes towards your wants, and then 20% goes towards your financial future. And personally, I think, the more you can bring down the cost of your needs and make your wants, as minimal as possible, obviously, the more you can put towards your financial future, the better. But you also want to have a balance of being able to live fun. I know there's some people that they live really, really frugal, where essentially it's like they have their basic living needs and then everything else, like 70 or 80%, goes towards just saving and investing. And I don't personally think that's the way to live. But this is a method that some people use, and you can kind of manipulate the numbers however you want. But that's just kind of it's just a method you can look at. So compound interest. This is one of those things where, we'll get into this more in the investing section, but it's really important to start investing early. So essentially, I've got a graph displayed here, and it shows four different investors, and depending on what time they start investing. So there's an age 25, 35, 45, and 55, and it shows you which this graph assumes an 11% annual return, which is kind of ridiculous. But regardless, it's $5,000 invested each year for 10 years with no additional contributions. But then you just keep reinvesting that money as it grows. So say, just for an example, you invest 5,000 and it's at the end of the year it's worth 6,000, which that would be really high. Um, then that next year it's like, oh, now I have 6,000 to invest with, and now it maybe makes it up to 7,500, and it compounds. It keeps going up and up. So essentially you get an exponential curve, and the earlier you start, the better. So let time work for you. All right, here's that inflation thing I was talking about. So this is another basic, is that money today is worth more than money tomorrow. Like a dollar today is worth more than a dollar tomorrow. And essentially that's because of inflation. So saving money is good, but saving money in places that grow is better. So for example, in 1955, if you saved $1,000, that at in 1955 terms, compared to 2017, that was worth $9,200 approximately in like today's equivalents. But the problem is if you saved that $1,000 in 1955 and you just had it in a savings account that whole time, you're still gonna only see $1,000 in your bank account. Even so, it's basically your money is losing value. That's what inflation is that your purchasing power goes down. So in 1955, compared to 2017, it seemed like it was about the equivalent of $9,200 today, but you lose that over time, and inflation fluctuates, but it's definitely something to keep note of, and it's why I believe you should have, a savings account, but you should also have a place that your money actually grows, like an investment tool.
I just want to say for the inflation amount, it's something like 3% each year,
Yeah.
between 2 and 3% each year, I think is what it's around.
Yeah, I
And
think I think that
so,
yeah, I think that's right. If
um,
you can see on the graph, that's about what it averages. You can see
yeah,
some years that go up way more than others, but yeah.
yeah, but around 2 or 3% is what I think it averages at.
Right.
And it's
And
funny because I just wanted to say that at Mystic, like they give us raises each year. So I'm not actually going to be working at Mystic anymore. I know in the last podcast I talked about possibly landing a job, and I did get the job offer, yes, on Friday for it. So
big
no more
congrats to
Mystic.
Big
Now
L.
I can talk
Yeah.
trash, but they would give us raises each year, right? And they didn't even equal like the inflation percentage each year.
Rip.
Like it was like something like a little bit less than 2%. And it's like that's not even close to a raise then. Like they're just being cheap. And
Yeah.
like any place that gives you like a 25-cent raise or something, like that's usually like minimum wage jobs.
Hmm.
Kind of like I was just working, and you know that's not even a real raise because it doesn't even keep up with inflation, and neither does savings accounts because like
Yep.
you get your 1 cent even every month for like every $1,000 or
Yeah.
something you put in it, and it's like that's not even close to it. So anything that makes above that 2 or 3% of interest back, you're at least making some money.
Yeah, and I believe so the S&P 500 index, that roughly on average it goes up about 7%. I think the stock market in general, it's about 7% a year. So we'll touch more on that later, but that's a perfect example of how you can actually beat inflation and have your money grow, make money for you, putting it to work essentially. But yeah, thanks for that. That's something important to note. That 3%.
Yeah.
Next little subject here is budgeting and saving. This is really core, and I think this is just enjoyable, honestly. So essentially, you should know what you spend your money on and where it goes. And you can use tools like, for example, in this PowerPoint, this is a screenshot from mint.com. So it shows you, this isn't my screenshot just for obvious reasons. I don't use Mint. I just do all my stuff on Excel because I'm a nerd. But this is just an example of, it breaks down your spending by category, gives you a nice little pie chart, and you can also set budgets on there where it's like, oh, how much do I have left? You know, in this screenshot, it's like, oh, I got $566 left. So you always want to make sure that you're in the green where you are spending less than you make. But the whole point of budgeting and saving is to really maximize your income and just plan. It's just nice planning. It's an absolute basic. You need to be budgeting and tracking your money if you want to get into that financial freedom realm. So short term, this is going to be things like your consumer goods and your fun stuff, leisurely activities, and then also an emergency fund for 6 months, which is something that I'm currently working on. And then medium term is vehicles and a home, and long term would be retirement. So you're trying to budget and save for all those three, short, medium, and long term things. Savings vehicles. So we'll get into investing later, but this is where we were talking about with inflation. So there's a few different money market accounts that you can do versus savings or checking account, certificate of deposit, a money market mutual fund. There's different ways you can save your money, and this is also something I'm trying to look into, but it is kind of a bummer right now. So the high yield savings accounts, essentially, what was I going to do? I think it was going to be through Robinhood and Roughly, that's an investing app. I'll touch on that later, but they rolled out a savings program where you can basically just chuck money into Robinhood and they'll invest your whatever amount that you don't put into the stock market. So it was kind of a high yield savings account. And it was supposed to be like a 3.5% annual return or 3.8. It was pretty damn high. It was like super nice, and I was really excited for it. And I don't know how all this works, but whatever with the banks and financial industry stuff, those interest rates got slashed. I believe the Fed, like the government, they can also determine some of this type of stuff. And so it was supposed to be like this above 3% thing, or barely, so it was beating inflation. And then now it's like 0.2 or 0.5. I think it's like 0.2%. It's really, really low now. So that's kind of off the table now. And you can see that this says this was made in 2019 or last updated then. But yeah, so that's kind of a bummer. And I talked with a potential financial advisor and I mentioned that to him. And he was like, yeah, that would have been the method to go for like like that emergency fund type account, that savings. He's like, that would be a perfect thing to do. But now that those interest rates were slashed, it's just not worth really. It's kind of pointless almost.
Have we talked about emergency funds yet? What
No,
those are, why you should have them?
no. You want to elaborate?
Okay, sure. So, yeah, the emergency fund is so we've been kind of trash talking those savings accounts just recently because you don't make much money off of them, but they are good for what's called the emergency fund, where you set aside between 3 and 6 months, sometimes even a year of monthly wages or part of your salary, and you just have it there for emergencies. It's as basic as that. Like you get in a car accident, you need extra money.
Mm-hmm.
You have the money now. You need a medical procedure, you have the money for it. Let's say you lose your job for a couple months. Now you have some money set aside because you're prepared for it. So that's what you want to have that emergency fund for, is just emergencies. And that's what's good for having a savings account.
Yep.
And that would have been a really great thing if you could have got 3% from just like your
I know.
emergency fund back each time. But yeah,
I know.
RIP, man.
Big rip. But yeah, well said. It's literally one of those things where it's some unforeseen circumstance happens and you don't want to just be living paycheck to paycheck. You want to have a nice chunk saved up where it's like, oh, I've got a big car bill now, or yeah, all of a sudden I lost my job. Coronavirus, I'm sure a lot of people ran into that, and those who were financially literate and smart that had, maybe 6 months or a year, that gives you a lot of leeway where it's like, oh, well, okay, well, I know I'm safe for, 6 months or a year without my job, so I can literally just hang out and job search, and I don't have to be stressed where I think I'm going to go homeless all of a sudden, which some people legitimately run into that issue. So emergency fund is definitely a core thing to look at. But that's kind of all I want to look at. On here, you can see there's some different saving vehicles like certificate of deposit, which I believe you get a fixed return, which still looks like it sucks and it doesn't beat inflation. So with that, well, I mean, I guess it's better than whatever. But I think with the certificate of deposit, you can't withdraw your money. Like you have to put it in for like a set amount of time, and you can't just use it. And that's of course a big thing where if you want an emergency fund, you obviously would need that money right away. You can't just, oh well, let me wait another 8 months and then my certificate of deposit's up and then I can pull my money. It's like, no, I need that money now. It's like J.G. Wentworth. We'll briefly touch on insurance. I believe there's just one slide here because this is just a reality of living. So the must-haves, at least in America, are auto insurance, health insurance. If someone depends on you, you really should have life insurance. So if you have a child, this isn't really applicable to any of us. And then home or renter's insurance. So right now I'm in an apartment. Same with Nick. So you probably just had to go get renter's insurance, I'm assuming. Yep. So I'd say auto, health, and home / renters. Those are the big must-haves. There's good to haves, which this is all. This is subjective to me because I didn't make this PowerPoint. I'm just going through information. But apparently supplemental disability and umbrella, which neither of those I know too much about. So I'm just gonna mention them.
Umbrella policies are like my parents have that for our family, and it's confusing, but like it just pretty much covers you like worst case scenario, like
The
it's
umbrella.
an umbrella.
Yeah,
exactly.
Yeah,
so it just covers everything that you own, so you're not, yeah. So
yeah, I got you.
It speaks for itself.
Okay, gotcha. So, and then another thing to note with insurance is your employer may provide this for you, or at least some of it, or give you some insurance plan, benefits or discounts. So just, make sure it's enough and look into that. But those are stuff you can't avoid, and that can be a pretty expensive thing. But that's all part of all your financial tracking and budgeting. Tracking your spend on a weekly, monthly, yearly basis. You should be able to figure that out no problem and see what's in your realm. Taxes
I want
also.
to say something.
Oh, go
Sorry.
ahead.
I'm in just for the insurance again. Sorry, I keep doing this.
No,
but,
you're good.
I was told recently by my dad that like if a company has health insurance and you are still under like 26, 'cause I think at 20, like at the very last day of you being 25 is when you're automatically cut from your parents' health insurance. So if your parents do provide your own health insurance and you go to the company and you say, oh well, I don't need it, and you ask them if there'd be an incentive to not have it, because companies do have to pay for the life insurance themselves too. So if they can save a few bucks, like they might reward you also. My dad was telling me about someone who would get an extra $50 each month, which isn't a lot, but it's $50, an extra $50 each month.
That's something I should look into, honestly, because with my parents, I'm on my mom's health insurance plan, because it's like, well, might as well just ride it until you're 25, and mine might even be 26 or something, just because it's like the
it goes
union.
till 20. Oh, okay. Yeah, end of 26 then, because it does go till 26. Like you have the last day of you being 25.
Oh, okay, I see. Okay, maybe that's what it is. So they just round up. But okay, yeah, that's interesting and something to look at. And I mean, personally, I think like if you can just keep it easy, if you're lucky, fortunate, like I would say I am, where I can just be on my parents' health insurance. It's like, or at least for now, it's like might as well just stick on it. I mean, my mom's not going to be paying anymore. It's the same regardless. So, yeah, good shit.
So I'll throw that out there.
Yeah, definitely. All right, tax. Touch on this real quick. I don't really want to go through this on calculating your taxes because, like, I mean, here's these slides if you want to look. But usually you can just do a tax calculator online. But at least in the U.S., we have a progressive tax bracket. So essentially, as you make more money or your household makes more money, you will get more of your income tax taken out. So it's a progressive tax bracket. A flat tax difference, for example, would be regardless of how much money you make, maybe everybody pays 15% of their income. So it really depends. So for example, just on the right here, if your annual, I don't know, what's the freaking AGI, it's something income, annual Gucci income, no, I'm just kidding, is 80,000
Annual gross income.
annual gross.
It's
There it
too
is.
gross.
Goddamn. It was escaping me. But if your annual gross income is 80,000 and that would put you in, say the 22% tax bracket, that means your taxes paid would be 17,600. So that means your after-tax income or your true take-home income, like what you actually bring home, would be 62,400. So this is something that, I mean, when you get your paycheck, when you do your budgeting, this will already kind of be factored into that, honestly. So, but it's important to know where you're at and just be aware of taxes and you'll probably get mad because you'll be like, well, what the fuck? I make this amount and I'm getting this fat chunk taken out. Nobody likes taxes. And that's why it's such a, political debate on, if they should be lower or higher and, what other different programs they go towards and all that kind of stuff. But usually, if you're really starting to get into money and financials and you're tracking it, you're probably going to just be annoyed looking at taxes. That's my experience. Because yeah. Anyways, moving on to investing. So this is, of course, says in 2019 again, but all this stuff this is the basics. All of this stuff, it's the same info essentially. So there's different investing vehicles, with the three main core ones I would say being bonds, stock market, and mutual funds. So starting with bonds, they're low risk, but they're also low returns. So they are essentially you buy a bond from the government, and I believe they've got a fixed percentage that they go up, and then that's essentially what it is. It's just a government bond, federal bond, if I'm correct. And you can see that they kind of vary. They're not. I don't know, that chart I'm seeing right there that you got. I mean, that's red, so it's went down, and that just does not look like the greatest thing to be investing in. That's the
Yeah.
Fidelity U.S. Bond Index. So I'm sure there's different ones that you can go after and whatnot. Then there's the stock market, which is probably the most common one that people think about, and I think it's a good one. So here's looking at the Dow Jones Industrial Index from, it looks like, about 2010 to 2018, and you can see at the start it's worth about 14,000, and at the end, January 26, 2018, it was $26,600, and it's pretty
That's
steady.
an index fund, though. That's not the stock market. That's
Oh
an
yeah.
index
Sorry.
fund, though. Yeah.
Yeah. So essentially, how the stock market is kind of seen, at least as I understand it, is there's different index funds that kind of track. So like the Dow Jones Industrial one, that tracks certain industrial companies, and it basically just averages them. So it takes a lot of them together, so you can kind of get an overall picture. So that's why I'd say the two main ones are the Dow Jones and then the S&P 500. So on the news, you'll see those both. And then what's the other one? NASDAQ?
Yeah.
Yep. So those three, the news will constantly look at, some are going to be green some days, some are going to be red, but all of those together gives you kind of an idea of where the overall stock market is looking, whether it's up or down, because it's a collective sum of all of those. So this isn't the whole stock market, it's just the Dow Jones Industrial Index, but it kind of gives you an idea. And there's certain mutual funds, which is the next one on here. So as opposed to buying individual company stock, mutual fund is a mix of stocks, bonds, and other things. And it's essentially it's pool money from a lot of different investors in many different companies, and you're having smarter people manage it for you, is what it is. So I'm not sure what's all in the Dow Jones Industrial one. I'm not sure like what amount of companies, but I guess first, so buying company stock, you're buying just essentially a small percentage of ownership of that company. And I mean, I guess this could dive in really deep, but I'm trying to keep it really basic here. But that's all it essentially is. So, say I'm just going to use Tesla for example, like throwing that out there. I'm not saying to invest in Tesla. Uh, Again,
We shouldn't at this point.
what'd you say?
Never, never mind.
But anyways,
I was just gonna say it's inflated, but
yeah. Let's just use Tesla as an example though. So Tesla is an electrical car manufacturer and battery company. And let's say Tesla's worth. This is not what it's actually worth, by the way. But let's say it's worth $100 right now. So you could buy that. You could buy three stocks of Tesla. So then that would cost you $300, and you have three stocks of Tesla. So now that might fluctuate, and this is all depending on supply and demand. So say there's a say Elon Musk smokes weed like he did, and the stock plummets like for the week after that because they're like, oh, I don't like Elon Musk. He's the CEO of Tesla. I don't like him smoking weed, so I'm selling my stock. I think that's not going to be a good look on the company. Which this is a true story. It wasn't a good look. So then it went down. So now say your stock went down to $50. So now you lost half your money because now the stock is worth your three stock is worth $150 because the stock price of Tesla is now $50. But then all of a sudden, the next week after that, Tesla unveiled this freaking craziest car. It's the best car on the planet, for example. And now the stock's $1,000 a share, and you kept your money. So essentially, you buy stock, you don't see that money. It's working. The company gets the money. They can do what they want with it. But then, oh, now Tesla, they made this amazing car, and there's so much demand, and everybody wants to go and buy it. Now their stock's worth $1,000 when you only spent $100 on it. So now your three stocks collectively would be worth $3,000, and then you could sell it. So then you would ultimately get $2,700 profit from that, which would be an unreal return, obviously. But that's essentially what buying stock in a company means. There's short-term, medium-term, and long-term stock strategies. We're not going to give any advice on that at all. That's purely do your own research. Be cautious and be sure to. I don't know. I'll just point you to Warren Buffett, for example. He's a pretty notable investor. Maybe go read one of his books before you start to do that kind of stuff. Mutual funds, as I mentioned earlier, these are a mix of stocks, so a mix of different companies. So this might be Tesla, Amazon, Walmart, it could be Target, it could be Dell, it could be Zoom video calls, it could be all of these together. So when you buy a certain mutual fund, you're buying a percent ownership in all of those, but you're not managing it. So to you, it's still going to look like a stock because you're just buying some, the Nick Beak 101 mutual fund, and you put it in that, it's gonna behave the same way as when you bought Tesla, for example. It's gonna go. Sometimes it's gonna go down, sometimes it's gonna go up, but hopefully long term you're gonna get a positive investment. So I feel like that's a pretty chunky amount of info on investing. You guys want to add anything to that?
I was just saying the reason I made it like kind of clear in the beginning when you were talking about the stock market and then you were pointing to the industrial index.
Uh-huh.
Like, yeah, the index funds are different than the stock market. The stock market's just like individual companies, and
Right.
then
Yeah. Sorry.
index funds are, and, I would say just it's kind of a blanket statement that index funds are like much less risky than buying like sometimes an individual company,
Hmm.
but there's still a significant amount of risk in it sometimes.
Yes.
But overall, like since it tracks like the S&P 500 tracking the 500, the Fortune 500 companies, like that typically goes up about, well, it changes per year, but around 8% each year. And so
Yeah.
I don't know, that's
So
that's a little bit less risky than sometimes buying something like Tesla,
yeah,
where
exactly,
you have no
totally.
idea,
And I mean,
how that's going to perform.
there is cases of people buying stock of some company where it's say it's worth $1,000, and then all of a sudden there's some giant bombshell report where they're bankrupt, and all of a sudden now it goes down to where they're literally worth dollars or pennies. And if you had a bunch of
Mhm.
stock, like yeah, you would lose a shit ton of money. So there's absolute risk involved in that. Um, but touching on what Alec was just talking about, so this is just the Dow Jones. It's not the entire stock market, but it's kind of essentially it just kind of gives you an idea. It's just an index. It kind of tracks a lot of different stocks. Um, and on average, it looks like roughly the stock market goes up about 7% per year. So looking at this chart, it looks like this starts around maybe 1900 or so. And you can see where it's white space, the stock is going up overall, and then the gray space is a recession. So you can see that this was like the Great Depression right here. I see it. And so that's where it's like if you bought right before the Great Depression, you were going to lose a lot of money because the stock market as a whole, all companies, all business in general, it was a depression area or era, sorry. And you can come up to here. This is the 2008 housing crisis and the Great Recession, as they call it. Uh, you can see there, of course, it just slams down. But on average, over time, there, even if there's these depression periods, it eventually does come back up, and that's just how history has been. So, like coronavirus, that's not shown on this chart, but obviously coronavirus really tanked this, and then of course it went back up after that, and now it's kind of slowly returning to its pre-COVID uh, price. So, but yeah, that's what we'll leave it at there. There's a lot of really good books on this type of stuff, but I would say something within the stock market or mutual funds is going to be a large investment tool for you. And Robinhood, which Alec, me and you will shamelessly plug our Robinhood links for people to do that. You can get a free stock actually.
Yeah.
Uh, but that is probably that's an easy way to start because a lot of other different places to trade stock and mutual funds, you will be charged a certain amount of money every time you buy or sell one. But with Robinhood, it's free, um, and I think they just sell your data.
Yeah. You
So
can't do you can't do more than 5 day trades on Robinhood, I'm pretty sure too.
yeah, and that's
You'll
I believe
get
that's
charged for
because
that as
you
well.
need over $25,000 in your trading account to be eligible to do
Mhm.
more than 5 day trades. Or yeah,
Mhm.
I think that's about the price. Um, yeah, again, closing up on some of the stock market stuff. So there's risk and return. So common stocks, 1 year holding period. It roughly shows this graph just shows a range of well, okay, so sorry, it compares stocks, bonds, and treasury bills, and it shows the amount of return possibility, but it also shows the range, and it's not all positive. Okay, so stocks definitely are the most risky, where over a 1 year holding period you might return over 50%, but then you also might return that exact same amount in the negative direction. So you either win or lose money. But as you see here, this is 5 year holding period, and then eventually a 20-year holding period, and then the red line in the middle is the average return, which it is positive. Um, but there is that risk, and that's all in that fluctuation over time. So yeah, if you're just trying to do something short where it's like, oh hey, my friend's telling me to buy this stock, and he's telling me, oh it's crazy, it's gonna go up, you got to buy it, and then you go, dump a bunch of your money on it. You're 99. Oh shit, messed up here. 99% you're gonna get fucked, and you're just gonna lose all your money because someone is piping up a stock that has no basis to it. So I don't know. Just anyways, just be aware that of course there's the chance of good returns and bad returns, but there's risk. There's absolutely risk, and the shorter term it is, the more risk you have. So, and it shows that government bonds and treasury bills, they're less risky. And now here's another important thing is the risk and diversification. So what you should choose depending on where you're at in life. So we are all early career, then there's mid-career, and then there's near retirement. So essentially, early career, you can, since you have time on your side, you can afford to be more aggressive. And so essentially you can have more of your portfolio in stocks, and then you could have still, just to be safe, you could have some in bonds and some in cash. And this is a lot of times, if your company has a 401k option, you can. I know when I went through this, I chose an aggressive route because it's early career, and sometimes these automatically will um, change depending on your age, essentially. So some of these 401k investing options, they will automatically start aggressive as you're younger, and then as you get older, it's going to slightly move more moderate and then more conservative, because once you get older, you don't want a lot of risk. If you're 64 years old and now you're dumping it all in Bitcoin or Tesla or something like that, you could literally lose your entire fucking life savings. So you want something that is going to be less risky as you get older. But as you're earlier, if you want higher return, of course, comes with that higher risk. So, yeah. Any questions there from you guys?
No,
All right.
it seems
Beauty.
pretty good.
I don't want to touch too much on IRAs because I'm still looking into this and learning about this. But IRA
I
stands
think.
for you what?
Oh, nothing.
Okay. IRA stands for Individual Retirement Account, essentially. And there's two types: there's traditional and there's Roth. Uh, and all transactions and earnings within the IRA have no tax impact. So this is usually a way where you can, because depending on the terms and stuff, you're putting money into an account, um, either post-tax or pre-tax. You can grow it either tax-free or tax-deferred, essentially. And sometimes it has to be in there early, or yeah, like right here it says able to withdraw money at 59 and a half, which I think maybe that's changed. Maybe it's 65 now, or it depends on what terms you get with what IRA you do. Traditional, for example, if you try to withdraw your money before 59 and a half or 65 or whatever it is, you'll have a 10% penalty and you'll pay a lot in taxes on that. Whereas if you waited until 59 and a half, you'll just get that money as income, and I believe it's tax deferred, I think. And then Roth has no penalty on principal. Starting.
So basically, like the 401k, you get taxed as your company, and you put money in. And the Roth you don't until you retire. And
Mhm.
so you gotta make a decision of, like, what, no one's gonna know what the tax rate's gonna be when you're gonna retire. So that's kind of like the risk that you take with Roth, is it could be higher than like the 10% or whatever it is. Well,
Mhm.
not 10%, like tax rate, but like I just know that you get taxed with the 401ks and then you don't with Roth. So like when you're ready to retire, like I think you get like a bigger chunk taken out. But with the 401k, it's just like it comes in increments, that when you're ready to retire, like you don't see a whole bunch of money disappear in front of you.
Mhm.
And some people do like a mix of both Roths and 401ks, because like they'd like to see that, oh, some of it's not getting taxed, and like maybe the tax rate's going to be lower in the future compared to 401ks, like where you're getting taxed now.
Yeah.
But yeah, that's kind of,
Some
I guess,
basics. Yeah.
very, very basics of,
Yeah, and here's a nice little chart too, which ignore the 6,000 a year that might be left in from company stuff, but um, yeah, I'm not sure where that number comes from. Essentially, before we go any further on this, like if you want to look into an IRA, essentially it's just an investment vehicle, a retirement investment vehicle, of course, IRA. um, you're going to end up consulting with a financial advisor of some sort. So you really should just talk with somebody in that field, and they will go way more in depth and give you more knowledge. But I will just summarize here real quick so IRAs, you will pay penalty and taxes, or for the traditional at least, you'll pay penalty and taxes for early withdrawals, except for some certain qualified expenses. But largely, if you early withdraw before your retirement age, which I think it's around 65, I saw 59 and a half. I also saw 70 and a half on the last slide. So I don't know which one it is, but there's an older age where you can actually withdraw it, and then you'll have distributions when you're retired. So traditional IRA contributions can be tax deductible, and then your earnings grow tax deferred, and then you pay income tax on distributions. The Roth IRA, you make contributions with after-tax dollars, so then your earnings grow tax-free, and then you do not pay income tax on distributions. So just kind of two different methods. And I think Roth IRA is something that I'm personally looking into right now. And with Roth IRA, you can pull out your Roth IRA contributions tax-free at any time. But I believe there's some sort of catch to that. Maybe not, because it's after-tax dollars.
59 and a half.
Yeah, I don't. This statement contradicts itself. All right, I'm done with IRAs. Talk to your financial advisor on that. But that is definitely a
we
big.
should never have talked about that.
Yeah, I know. We none of us are even close to retirement age.
Yeah.
But it's definitely something I'm looking into. Just know it's there and that there's differences. So
This is still.
I feel like this got out of. This is like a tax thing. Well, let's talk
it's
about
about the 401ks.
Yeah. Okay. So, essentially, a 401k, of course, is another investment retirement vehicle. So here's another example, and this is how essentially with 401ks, you can contribute pre-tax. So you have your yearly salary, say it's 80,000, and you want to contribute 10% of your salary every year to your 401k. So that would be $8,000. So now instead of your taxable income being instead of your taxable income being $80,000, it would now be $72,000. So with that same tax rate earlier that we talked about, 22%, now your taxes paid are $15,840 as opposed to $17,600. So essentially, you would save money that would otherwise go to taxes by doing this. So that's an important thing to note, and I'm taking advantage of that with my 401k. Let's get into credit. So, credit basics. This thing looks like it got messed up a little bit here. Alrighty. So a credit card, essentially, just real quick. If you have a credit card for $1,000, that's money you don't have. It's credit. It's money kind of loaned out to you. So you could go blow that $1,000 on whatever you want or whatever, but then you're just going to be responsible for paying that money back to the credit card company or the bank or whatever it is. So with that, though, you do get a credit score. And with a better and higher credit score, you'll get better interest rates. It's easier to get approved for other credit cards and mortgages or loans. Credit Karma is what I use, and that's a way that you can track your credit score, and it'll show you info on how you can make it better. And you can see this chart here. Factors that determine your credit score. So payment history, that's a big chunk, 35%. Amounts owed, 30%. Length of credit history, 15%. And then new credit and types of credit used are about 10%. So the biggest one is payment history. So essentially, you should never miss a payment on your credit card. And that is the biggest way to have a good credit score. And then another big chunk, of course, is to maintain low credit utilization. So for example, if you have a credit card that is a $2,000 credit card, then you should try to keep it below a 10% on that. So just because you have 2,000 on your credit card doesn't mean you should put 2,000 on it. It means like, oh, okay, well, maybe if you go get a big grocery run and it's 200 and you spend $200, that's that 10% amount, and that is something that will reflect good on your credit score. Another thing is to keep credit for long periods of time and average, 9+ years. So the earlier you can actually get approved for a credit card, the better, and you can be smart with it, of course. You should be able to get a small one starting off, and you just use it for, literally groceries or gas, and then you just focus on paying it off right away. And then, over time, of course, that'll just add up. And then it basically, what credit cards do and credit score, it basically proves to, if you're trying to get a loan to buy a house or something like that, or you want to get a new credit card for, certain miscellaneous expenses or business expenses, it means that they can basically just look at like, oh, well, let's look at their credit score. So if you have a really high one, it means like, all right, this person, they pay on time, they always keep a low balance, so it's just safe. It basically means that the credit company or the bank, they have low risk giving you the credit card because you have a good credit score. They know that you're going to pay it off. And yeah, there's some other stuff on there as well.
I just wanted to say you should never have if you are going to buy something with your credit card, you should have the money already in your debit account to
Yes.
pay for it.
Yes.
You should never like hope that like, oh, well, I'll just like wait for 2 weeks from now for when I get a paycheck or something. You should already have the money ready to pay it off. And that 10% is only for when like the billing period comes around. Like you want to stay underneath that. So like let's say you spend $500 that month, you went over the 10%. As long as you pay it off so that like when your bill comes through and it's less than that 10%, then you're fine. So you know, with a credit card, you get to set up what day you're going to pay. Like I chose the 7th because it's an easy number to remember. 7. So yeah. And so just like pick a time of the month where you can pay it off and you're going to remember to, and just be aware of what your account balance is before that time so that you can get under that 10% and keep growing it. And then also, if you notice that your credit, like if you check Credit Karma kind of often and you only have like one card and you see it's not really going up by much, like maybe, but you've been like for months consecutively like paying everything off and staying underneath that 10%, then it might be time for another credit card.
Yeah.
Because then it already went over on the last page. I think like 10% of it comes from like how many new credit.
Yeah. So essentially that's like a new inquiry where it's like you kind of want to limit these, and I know that this has impacted my credit score a little bit recently because I got an apartment, I got a car in February. I'm just there were certain things where it's like, all right, I was just taking a deal of advantages. A lot of credit cards also, you can usually get a bonus for signing up, and sometimes it's just like a free, I know the Amazon one, it's like a free $100 to spend on Amazon. It's like, oh, cool. Like, why not take advantage of that, right? And there's other ones that, that you can get a lot of flight perks and stuff like that. So yeah, obviously if you can, like, there's a reason why there's incentive to get new credit cards, but it will affect your score when you are like, hey, I want to get a new credit card. That's going to have a little bit of an impact on your credit score temporarily, of course. But over time, like here it says total accounts 21 plus is a good credit score. And I know that mine, I don't know if I have like 9 or 10 accounts or something like that. But it's basically, it tells me on Credit Karma where it's like, that's bad. And I'm like, what? I feel like that's like a lot. It's like, I don't want more than that. But no, the more the better, because eventually over time that all builds and it just shows, especially if you're good with all of them, which you should be. And of course, what Alex said, that's key. You should absolutely already have the money before you're paying off your credit card. Like, it's more so, it's just, as opposed to taking it straight out of debit, which is what I used to do a lot of in high school. The credit card, you can build your credit and it allows you to get approved for things you want, like especially if you want to buy a home or get involved in real estate type stuff. You're going to need good credit for that, where obviously you just paying from your debit card that's not going to prove anything to anyone because that's not tracked. So and Alec talked about, so you can go over, of course, that 10% amount before your bill comes. So it's not like as soon as you spend money with your credit card that, oh shit, I've got to pay that bill like the next day or like this next second. probably depends on where you get it from, but essentially, I don't know. Yeah, you said, is it like once a month? I mean, I literally like almost always pay mine off before even a balance comes up. So I don't really know. But a balance comes up where it's like, say you did spend, $200 at the grocery store, and then you don't pay it off for a month, then that's going to show up in your next. It's going to show up as a balance that you need to pay by a certain amount of time. Um, and it'll just show up as $200 essentially. But for example, if you did spend more than you wanted, say you spent 500, you could pay off that 300 real quick, and then the balance that would come over after that would still be that 200. So then it would say be at your 10% level, for example. There's fees and finance charges if you do not pay it off on time. So that credit card debt is it's really bad. You need to avoid that at absolutely all costs. I mean, there's countless stories. You could probably look up people that get into credit card debt because they get a card that allows them to just spend money, but if they don't actually have that money, I mean, to me, I mean, I've been lucky growing up where it's like that's just common sense, like distilled into me that you can't spend what you don't have. But some people obviously are not that way. So if you're listening to this episode, congratulations because you're going to be pretty financially literate, or at least just on the core basics. Like um, none of this should be like disputable really at all. It's like we're really just trying to keep it really core basic of just like smart money stuff. So
Smart money stuff.
smart money stuff. Take it to
There
the
we go.
bank, baby. um, but yeah, I mean, and I talked about some of those flight. Some rewards are cash back, which is nice. It's as it sounds. You get cash back spending and paying off your stuff on time, and then you get points and miles that you can use to travel to cool places. So there's definitely benefits to credit cards. Just be smart with it and pay off all your shit and make sure that you have your money. So I'm gonna leave it. I'm gonna be done with that for now. We're almost getting to the end here. It's a filled episode, trying to get it squeaking it out under an hour, but this should just be real core and really just unfiltered. So I want to talk about loans real quick. This is the last subject. So loan essentially, it's just someone's borrowing you money, or a bank is borrowing you money, because obviously if you are buying a $200,000 or $300,000 house, 99.9% of people are not going to just have 300 grand just to go slap on a house, So a loan allows you, and the same goes for like education and stuff. But a loan allows you to get that money where they'll go pay it for you. They'll buy the house, so that person who owned it beforehand, they'll get their money, but then you basically will just pay it off over time, and then there's an interest rate. So the person loaning you the money, they know that over time they're going to gain interest off you. So for a really dumb example, let's just say you bought a house for $100,000 and you're going to pay that loan over 10 years. And I don't know, I'm not sure what the interest rate would be. Let's just say that essentially the home loaner, or the loaner that lended you money for the home, they are going to charge interest, and it's say over that 10 years it's basically going to average out to $1,000 a year. So $10,000 is what you're going to be paying extra. So it's like, yeah, the home was $100,000, but you ended up paying $110,000 over that 10 years, because that's how the bank makes their money. They loan it to you, they charge a little bit of interest, they make money. They made $10,000 off loaning you the $100,000 to start. So, and of course you get a better interest rate if you have a better credit score. So yeah, some of those common types are education, student loans, auto loans, and home loans. Those are probably the most common. And then there's a couple of different types where installment loans. So essentially, you pay the same amount each month. So it's a fixed amount, and you pay a mixture of interest and then principal. So principal is going towards that core 100,000, and then that extra 10,000 that you're charged in interest, you would have a chunk of that would go for every every payment that you make as well. I'm not going to go through this table of examples. It really kind of gets into the weeds. But a lot of companies, they'll do more interest up front. So you may say you make a payment for, $1,000, and you're like, oh sweet, I'm just going to pay off $1,000 on my home loan. You might only get like 500 or 600 of that goes towards the actual loan. There's going to be a big chunk that goes to interest, and you're going to be like, what the hell? Like, that makes no sense. I want that just to go to the home. I'm just paying that. Where it's like, well, okay, well that's just how loans work. That's how interest works. And a lot of times, a lot of banks and lending places, they will stack their interest at the beginning, and then it'll kind of taper off as it goes later on. So it'll get less and less. But that's how they capture more of their money earlier on. So, and I think
I just want to say something about
yeah, go
interest
for it.
quick. So like I haven't bought my first house yet. I'm like 24 years old, but I just looked up like what some of the average like mortgage rates are. It seems to float between like 3 and like, well, closer to 4%, and then like between 3.5 to 5%, I guess. So if you're doing investments in other things that are making, like, let's say you do one of those bonds and your bonds only make you 4% each year, it's like, well, maybe rather than spending your money and trying to like invest some of your money into those bonds, which are maybe making the same amount of money, or getting an interest rate that is just about the same as your mortgage, like you might want to just pay off your mortgage first, because the two are kind of just canceling each other out then, or like maybe you're even losing money by trying to invest some of it into like a bond compared to paying off your mortgage. So you want to always be aware of like how much interest like everything like your investments are getting, and then your mortgages, because then you can prioritize what you should be doing, if you should be investing or just trying to pay off.
Yeah.
Yeah,
that's a good point. You bring that up. Thanks for that. So that's all I really wanted to touch on.
I mean, it's blown off. Like, oh, appreciate it, thanks.
Well, no, I mean, like, no, I'm trying to. I realize
it's just basic. I mean, it's
yeah.
obvious, but like, some people don't think like that.
Yeah, no, I was literally just like, I think it's just a good addition. Like, I think that's no. So
I just thought it was funny.
Fair.
Like, just shut the fuck up, Alex.
No. That's not what it was meant to be at all. No, it's truly, that's some good shit right there.
But like, same thing with like car. Like when people buy a car and their interest rate is like ridiculously high, but they're trying to invest also. It's like, no, you should try to pay off that car. Like, why are you trying to invest? Like,
yeah, it's a true trade-off, and the same goes for student loans too, which we know that Big Elk, he doesn't have none of that shit. But
that's where we budgeting.
Yep. But yes, yeah, that's one of those things where I have a book that it's like how to eliminate student loan debt, which I need to read. It's actually a pretty short one, and I'm just like starting to come up. Well, I think my grace period ends in like 2 months or something like that. So then by that time, I'm just gonna have a game plan going forward. So, but yeah, that's absolutely something to look at. Where it's like, it's a joke if like, oh yeah, I'm averaging 2% my investments, man, and then it's like, all right, well, your loan is costing you like 6%. So congrats, you're losing 4% still. So it's absolutely look into it. Essentially is what we're saying. All right, you guys ready for the closing actions here?
Closing.
Now what actions? Okay, so this is Practical Prosperity. We are trying to give you guys actionable advice and practical advice, just based on personal experience and stuff we have access to. So at its core, it's like, now that you have all this information, like, what are some true action items you can take? And it would be to not take on new expensive debts if you don't have to. Obviously, if you're entering college, you're probably not going to have college paid for you. Spend what you can afford. Um, but if you have to take a loan, like education, honestly, student loans would be like the biggest one that I would think about of people having to deal with this early on. Is you may just have to take student loans. There's no option for you, especially with how fucking expensive college is. But anyway, so mortgages, education, and car loans, they can be okay. It all depends on your budgeting and your planning. But credit card debt is really just, it should be eliminated. It's never okay, essentially. And be sure to watch out for interest and fees. So that's the first action. Second action would be track your damn money. Know what you're spending your money on and where it's all going, and then make a plan to increase your savings and make a plan to invest your money. So let me just touch on this top slide again, that 50, 30, 20 method, where it's like certain percent goes to needs, certain percent goes to wants, and certain percent goes towards your financial future. That's really, really, really key. It's really key. So track your damn money. And then the third action is don't be afraid to manage or invest your money. So whether this is on your own if you feel confident, or if you want to talk to a legitimate financial advisor, someone who's going to be honest with you and not be a scumbag. Of course, be cautious with Googling stuff. Honestly, there's some links on here where it's Reddit, personal
I
finance.
see, it's funny they put on Reddit.
I know.
Like what the company put on Reddit.
Yeah. Which I mean,
Nice.
honestly, there's some good stuff on there. I know Reddit can be pretty cancerous in a lot of ways, but I know there's definitely some subthreads of Reddit that are really like positive and all about like helping out other people, and you can get some
Oh,
legitimate
definitely.
info on there. And I did look at that one real briefly, and it seemed like it was in that good category. So, but of course, be cautious
Yeah.
still.
I just think it's funny that they plug
Yeah.
in Reddit,
Reddit.
for like a place where anyone can post things. And
Yeah,
it's just like, is that really where you want to go for financial advice?
Yeah,
Like,
totally.
oh yeah, follow Robinhood penny stocks and lose money by buying
Yeah,
pennies.
no, obviously everything needs to be taken with a grain of salt, including this financial advice. But as I said, this was not, which I took out all company info on this because there were certain slides that were purely company info. But this was collected over, engineers they're pretty nerdy with money. I know I'm nerdy with just numbers and stuff in general, but it's not like this was just some bullshit I threw together. This is from people I trust that have gone through all this stuff. I mean, they've truly done it, and it's essentially, this whole PowerPoint was for new hires, people like me, like new fresh engineers, to give us the full rundown as we just did for you guys today. But so I'm going to close on that, where I'm going to move back to the Zoom meeting now. Zoom meeting. There we go. But yeah, so those are the final. What, Alec? You got something to say?
No, I really don't. I had an unexpected like burp, and I didn't know if like the mic caught it.
Oh,
I hope not.
maybe.
So.
Maybe someone will comment down below.
Like nice.
Yeah, nice burp
Nice
there.
at 1:02, whatever.
Yeah, exactly. Yeah, probably about right. So yeah, those are the final actions. I think biggest thing for me is like tracking your money like almost anally. Like every single fucking penny that comes in or out of my personal finance situation, I have it tracked and I know exactly where it goes. And I think that's just a really big thing, because that really it lays the groundwork, because you'll do that and then you're going to just gain insight from doing that naturally. So it's like, whether it's cash or change you're spending, or of course debit or credit cards, especially with nowadays, it seems like all of that it's readily available knowledge to you. But that's really a big one. And then of course knowing that, all right, hey, I don't have to be afraid to save or invest my money. So you guys
Yeah.
want to add any thoughts? Or I guess that was also new information, or not new information, but like that PowerPoint you guys have never seen before. So any general thoughts on that? Go start with Nick first.
I mean, a lot of that stuff I already knew just because my mom.
Oh, it's really quiet.
So, oh, can you hear me?
Kind of, yeah.
Yeah, it was pretty quiet.
So, hopefully you guys can hear me. So it's so bad.
Yeah, I don't know why.
It is. It's just quiet.
Yeah.
Yeah. You were talking fine earlier. I don't know why.
I don't know why it's
All right. Oh well, we'll turn it up for Nick.
bad mic.
So sorry, what were you saying?
Oh, so I was gonna say get the NerdWallet app. They just came out with their app like recently, and I downloaded it thinking that it's just gonna be like a crappy, bank, like it's just a crappy finance app, but it's actually really nice. It shows like your credit score, it shows your net worth, it shows like you able to put in all your credit accounts and all your bank accounts and your auto loan, just anything, and it shows you okay, money coming in, money coming out. It shows all that. It shows where you need to be or where your goals are at. It's an awesome little app, and it's free. So
Nice.
it's like an all one-stop shop of like all your finances in one picture, and it's cool to see your net worth like grow over time with your investment accounts attached to it, and or you're paying on credit cards or loans, whatever.
Yeah.
You see that number go up, and it's like, oh, this is sweet. Or your credit score going up, and it's like, oh, I'm doing something right. So it's it's cool.
Cool. Okay, cool. That's good to know. And aside from my Excel sheet, I think I got an app one time. It was called like Wallet or something, and it really wasn't too automated, or it wasn't as in depth as I wanted it to be. But I'm definitely down NerdWallet. I'll keep that in mind. That'll be something I'll get, because that would be nice to have
same.
everything all collective at once. But I'll still probably I'll probably do both. I don't know if you do an Excel sheet at all either, Nick.
No.
Okay. Alec, you
I
have
do
an
the Excel sheet.
Yeah. I would assume that I would still do that just for my own personal tracking type stuff, because I like knowing where all of it's going. Just gives me like full visibility. So
Yeah, does NerdWallet track all your payments and everything then too?
Yeah.
Wow.
Yeah, so like it's on the dashboard when you first log in, like because I have the newer iPhone, so just I log in with my face, and then
subtle flex.
when you first on the home, yeah, subtle flex. I don't have the new one. The Face ID thing's been out for a while, but like, no, it's on the dashboard. It has like a little box. Okay, here's your net worth, here's your credit score, and then at the top it shows okay, this is what you get paid, like your cash flow, your personal cash flow every month. And it deducts from your checking account or whatever you spend. So like if you spend on your credit card, it takes it out of that amount. If you spend on your debit card, it takes it out of that amount. So any spending you do, it comes out of that cash flow like that it shows you. But the credit score things are obviously only updated every couple of weeks because they only check and do constant checks like monthly or every couple of weeks.
Right.
But no, it's cool to watch. Like my 401k this past week has just exploded with how the market's been doing. So it's cool to log on to every day and see like, oh, my net worth is just going up and up and up.
Yeah.
So it's cool to just watch that like grow.
That's awesome.
Yeah, I totally recommend it.
Good shit.
Yeah, I'm gonna have to get that.
Yeah. Big out closing thoughts on the PowerPoint.
Yeah, I agree that the budgeting thing is probably one of the biggest. Like tracking your savings and everything and how you're spending your money is one of the biggest ways. I've never been in credit card debt, but as you were talking earlier, it's an awful thing to be in. So just if you have a credit card and you have accounts, like make sure that you know where all your money's going and you spend it wisely. I think anybody who is listening to this podcast is looking to grow their knowledge on it. So that's probably pretty obvious, but for some people it's not. And yeah,
definitely.
Track that money.
Cool. All right, well, yeah, I'm gonna close it there. So thanks everyone for watching. I hoped it was really beneficial or kind of eye-opening, especially if there was some new stuff in there for you. I know when I first went through that, and the same thing goes for finance books. There's some stuff that's really really eye-opening that just makes you excited to start attacking your financial situation essentially, because again, it's all the whole point of being smart with all that stuff is to get to a point where you are just financially free and you can just live a fulfilling life doing whatever you want to do every day, every second. So you don't have to slave away at nothing. It's kind of the end goal. Or if you want to work on the moon missions, that's another end goal, which I totally understand. So, all right, but yeah, leave a comment or a thought on what you thought. Wow! Yeah, just an amazing ending. But no, seriously, thanks everyone for sticking along. Hope this was good. We will see you guys next time.